Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-host, CoinDesk contributor, Lawrence Luton, and Executive Director of Global Content, Emily Parker. Good morning, Emily and Lawrence. Happy Friday, Junior.
Yes.
Morning.
All right, let's take a look at the markets. Seeing a lot of red. The CoinDesk Bitcoin price XBX index at $21,694, losing about 1.3% for the past 24 hours. The CoinDesk Ether price ETX index at 1538, also down about 0.9%. And the DFX CoinDesk's DeFi index at 128 in the red, just over 3%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. And so our top headline of the day, another crypto giant fallen. Crypto-friendly Silvergate Bank will voluntarily liquidate its assets and wind down operations, its holding company announced last night. Is that why we're seeing a little bit of bearish sentiment in the markets, Lawrence?
Well, you sure aren't seeing bullish sentiment over it. I mean, this is definitely not a great thing for crypto in general. Just in this sense that this is a financial institution, traditional finance technically, but it was one that was very much knee deep in crypto. This was what they were all about. And a lot of American and non-American firms really depended on Silvergate for some of their banking needs. They've had to go on elsewhere. Signature Bank, I think, is welcoming quite a few customers right now. But it's certainly a reason why we saw Bitcoin was below 21 at one point. It's not good. This isn't a bullish thing for crypto. Then again, it's not down to 15, which I guess is okay.
Yeah, it's actually surprisingly resilient, the crypto markets.
Yeah, but I mean,
I would actually agree with Christine I'd agree with Christine there. Like, I don't actually think it's down that much given the wave of bad news. I mean, it's not even down that significantly. It's gone down much more on much smaller things. So this is just another example of how Bitcoin is not primarily related to crypto-related events. It's reacting more to macro factors, because I don't think this is a big fall at all compared to how big this story is.
Well, let's discuss further and look at the state of crypto.
The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
All right, joining us now to discuss and dive further into the details of Silvergate is Bianco Research President and macro strategist Jim Bianco. Jim, we saw a tweet from you yesterday saying that before Silvergate's announcement, you said SI, which is the stock ticker for Silvergate, is now down more than 98% from its November 2021 peak. History says that stocks that lose this much often lose that final 2%. Unfortunately, the cancer known as FTX Alameda ruins good companies along with bad ones. So contagion is not over in the crypto markets.
No, unfortunately, it's not. And yes, once you get a stock that gets down this much, the bet is that they eventually go to zero, which appears to be the case, unfortunately, with Silvergate. The bigger problem I think that the industry is going to have, the crypto industry is going to have, is most TradFi firms operate under a fiduciary rule. They have to act according to the fiduciary rule responsibly. That means now, after this failure, on top of everything else, it's a career risk for any traditional financial firm to put money in crypto. Because if you put money in crypto and it goes down in price, there's something wrong with you. We have to reevaluate your relationship. You put money in Tesla and it loses half its money. Well, that kind of happens with tech stocks. But so this is the taint that crypto is going to have to face. So adoption from the TradFi space got just that much harder in the last 24 hours.
Yeah, we're hearing more criticism and caution from regulators and federal agencies like SEC Chair Gary Gensler, Fed Chair Jerome Powell, saying, banks need to be cautious when dealing with crypto assets. So I'm wondering, will this eventually have a chilling effect routes to TradFi. We just reported yesterday that JP Morgan is cutting ties with Gemini and ending its banking relationship there.
Yeah, I mean, this is going to be more difficult. You're right. In the last 2 days, Chairman Powell has been testifying on Capitol Hill, and he's been asked several questions about, about crypto. And his opening statements usually have the word scam and fraud when he starts to explain the crypto space. And they use their new tagline is safety and soundness that they're using. So they're really trying to, there's a pincher move going on by regulators, right? The SEC, the OCC, the FDIC are saying you need to use a qualified custodian like a bank. So let's shove everybody to the commercial banks to use them as the custodians so that the Fed could come by and some of the other banking regulators and say, don't touch this stuff. And so it's going to be very difficult to get through. I mean, what we would need in this space is something like Custodia to basically get their Fed license, but it's very clear that there's no interest in allowing that to happen either. So the space is going to have a difficult time when it comes to the on and off ramps and trying to adopt traditional finance into the space. Eventually it's going to happen. It's going to happen just like in the early days of Uber. The taxi drivers turned over the Uber cars and let them on fire, and the city councils banned it. But eventually it won out, but it wasn't an easy process. Unfortunately, this one isn't going to be either. But I still think crypto is going to win the day at the end of all of this.
Isn't part of the problem, though, the fact that, there were several problems with Silvergate. And you and I had this discussion yesterday. It was part of this whole thing on Twitter Spaces. It was wonderful. I wish everyone had heard it. But there was this whole idea, a bunch of things. First of all, they didn't have a diversity of deposits the way a larger bank would have had. But second of all, Silvergate's management did a really lousy job of dealing with their assets. They went out and bought relatively longer dated bonds at a time when interest rates were going up. They bought real estate at a time when interest rates are going up. So even though banks usually do well when interest rates are going up, they did everything wrong when it came to that, or it seemed they did a lot wrong when it came to that. So they didn't have a diversity of assets, and they managed their situation. They didn't have a diversity of liabilities, and they also did a poor job of managing their assets. Isn't this more unique to Silvergate than anything else? And does this actually mean, I don't know, that maybe the smaller guys that are willing to take crypto might not be the best thing for crypto in general, and that we should all kind of be worried about them going forward?
Well, you're
the
correct.
Of the world, even.
Right. Not necessarily for this, just because they're smaller, but you're correct. They made mistakes. You don't go to zero because you're a complete victim of circumstances and you did nothing wrong. Lots of banks are making those same mistakes that you've made. The problem that they had, of course, was that they were highly concentrated in an industry, crypto, that has fallen on very difficult times and regulator scrutiny and a whole bunch of other problems, and it all cascaded together at once that made their depositors, the crypto people that operated with that bank, lose confidence and want to leave. So when we started to see the press releases last week that certain Galaxy Digital and a bunch of others were pulling out of Silvergate, that was kind of the beginning of the end right there. It's very hard to pull out of some kind of a death spiral when you do that. But you're right, they made mistakes. But I would also mention that those mistakes you described are being made by a lot of banks right now, but they're not in an industry. They're not lending or custodying assets like the crypto industry has been under the intense regulatory pressure and the price fall, so that even though they're making maybe the same mistakes, they can survive it, where Silvergate had to be perfect because of the industry they were in, and they weren't, and they've paid a heavy price for it.
No, less than perfect.
Did they have to be perfect because of the industry that they were in, or did they have to be perfect because there were so few players doing this?
I think it's a combination of both. I mean, mainly though, the industry that they were in. They were in an industry where the prices are down 70 to 90%. They were in an industry that is under intense regulatory pressure. They are in an industry that has been tainted by fraud and mismanagement because of all the previous failures. And they had a large customer than FTX that is involved in a terrible scandal. So that if you put any bank in that situation, the only way that they're going to survive that is that they're going to have to be nearly perfect or perfect. And that's asking a lot because very few banks are. So they were put in a bad place. Now, if they were bigger, what we're suggesting there is if they were more diversified, if crypto was a smaller part of their business and they had a big industrial lending and commercial lending, residential lending, small business loan businesses that could absorb those losses, they might have survived. But they didn't. They were very, very concentrated. So yes, if a Custodia comes along or something like that, they're going to have to play it very, very close. It's not impossible to do it, but that's kind of a mindset that comes in there that you have to be, you have to be perfect. So it's a difficult business.
What do you see? Do you see a further contagion effects from here? Is there going to be sort of a domino effect that we've seen with a lot of these other failures?
People are looking at Signature Bank.
Yes, I was going to say everybody's going to focus on Signature Bank next, and they're going to get a lot of scrutiny. The regulators are going to focus on it quite a bit as well. Now, whether or not Signet, their operation falls to the same acts that we've seen with Silvergate remains to be seen, but it's going to be very difficult for them. It's not a good day for them that one of their competitors has fallen on this hard time, so that means they're going to get more business. They'd probably prefer that they didn't get more business this way. So it is going to be very difficult. And if there was any other bank or a mainstream bank that was thinking about trying to get into this business, it's gotten that much harder for them to want to get in this business. The regulatory headache that they have to go through to just get into this business. Look, bring up Custodia again. I mean, they can't even get a license. And think about how difficult it has been for them. Why would a Wells Fargo or a Bank of America want to beat their head against the wall to try and get into this business, at least right now? Maybe later on in life, when things have calmed down, they might want to do it, but not right now.
Yeah, I see Signature Bank stock down about 8% in the pre-market. Silvergate down 37% right now. Jim, thank you for joining us. That was Bianco Research President and macro strategist Jim Bianco. Coming up, we've got a crypto markets update with financial management consultancy Opimas. Checking in on Bitcoin, the CoinDesk Bitcoin price XVX index currently at $21,703, down just over 1% over the past 24 hours. The CoinDesk Ether price ETX index at 1540, losing about 0.7%, and the DFX CoinDesk DeFi index in negative territory at losing 2.9%. The most reliable reference prices for institutions in 2014 are now published on the CoinDesk brand.
And the decision by crypto-friendly bank Silvergate to wind down operations amid the worsening macroeconomic picture is fueling some investor anxiety. Joining us now to discuss the crypto markets is Octavio Marenzi. He's CEO and founder of management consultancy Opimas, LLC. Welcome back, Octavio.
Good morning. Thanks for having me.
Glad to see you again. So what's been the general market reaction from where you are to Silvergate's liquidation? We saw Bitcoin, of course, fall below 21,000 in the past few hours. It's back up a little bit. Nonetheless, is this a death by 1,000 cuts? I mean, it's not necessarily going to knock the market down to 3,000, but is this something that definitely is going to bleed the market for a while?
I think you're right to see it as death by 1,000 cuts. Bear in mind, a 1%, 2%, or 3% movement in Bitcoin prices, that's all in a day's work for us, I think. There's nothing unusual about that. So if anything, you can make the argument there's reduced volatility in the Bitcoin market, that this kind of is a relatively small price movement overall on a daily basis for Bitcoin. So it seems like the markets have reacted to Silvergate, at least in terms of cryptocurrency prices, with a really big yawn, basically saying there's nothing to see here, keep moving on. It's of course been very bad for Silvergate's stock price, but the broader crypto market does not seem to be impressed at all by it.
As I said in the intro, there's of course a macroeconomic backdrop here, and that is that we might see the Fed raise rates by 50 basis points versus 25 basis points that was expected just a few weeks ago. Is that having more of an effect, do you feel, on crypto than the demise of Silvergate?
That is definitely having a bigger effect on crypto and markets more generally. So I think that is weighing on things. The fact that basically Jay Powell has come out and said, we're not finished with these interest rate hikes. We have to carry on going. Who knows where we're going? I mean, they're going to play it meeting by meeting. But I dare say I wouldn't be surprised if we saw interest rates, Fed fund rates go up to 6, 7, 8% this year. So that's sort of what I'm counting on. I've been basically calling that for about a year now. But I think that's where we're going. And Jay Powell has signaled that quite forcefully, I think, in his most recent testimony.
That 8% is disco era.
Indeed. If you remember those days and high interest rates and sort of bell-bottom jeans. Yeah, it's hard to forget it.
Yeah, Donna
Any
Summers.
Thoughts on the Grayscale Bitcoin Trust discount? To NAV, it's now narrowed down to below 35%. And of course, CoinDesk and Grayscale are both owned by DCG. But is this a sign, coming in the future that institutions might be able to gain exposure in Bitcoin through a Bitcoin spot ETF?
I mean, I think they certainly would be looking at that. I mean, if I were sort of an institutional investor, I'd be taking a very, very close look at that and trying to figure out why is there this enormous discount, and can't we take advantage of that by jumping in now? I guess I think the whole crypto market, though, in terms of institutional investors, has been so soured, and they're keeping so far away from it, that even this kind of enormous discount in terms of NAV to basically book value is not even attracting them and bringing them in. So I think there's just a tremendous amount of mistrust at the moment. Institutional investors are just keeping well away from it. Now, we keep thinking the big institutional investors are going to come back. Your previous, the person you interviewed was talking about eventually it will happen that we'll see the large institutions coming in, traditional institutions investing in crypto assets. I've been waiting for that for a few years now. It always looks like it's just over the horizon, and the closer we get to the horizon, the further behind the horizon it seems to disappear. So we're still waiting on that, but hopefully it will come.
Any day now.
Yeah, well, it seemed like last year was the year, and until it all
last year
crumbled.
was the year, wasn't it? Yeah, and the year before, but last year was going to be the year. Yeah.
You're also taking a closer look at DeFi in global fixed income markets. What are some of your key findings there?
Well, we've been studying that market a bit and trying to sort of figure out how big are volumes really, sort of if you look at sort of the traditional fixed income markets, because I think we had expected to see a big shift away from traditional bonds being issued to more sort of tokenized bonds or digital bonds or blockchain-based bonds or what have you, whatever you would like to call those things. We've seen a lot of noise and press releases about that, but we actually went out and sort of dug into it and tried to see, well, how much activity is there really? And we sort of came to the sad conclusion there's very, very little indeed, despite all these announcements coming out. And even some of these announcements are somewhat questionable in terms of how much they've really generated through these issuances of DeFi bonds. So at the moment, basically the DeFi fixed income market makes up for a really, really small, vanishingly amount of the overall market. I mean, there's growth potential there, but it's far from where you'd expect it to be reading the press releases.
Nonetheless, I mean, what do you suspect is the reason? How would you explain it? Is it a lack of faith in the structure of the DeFi markets? Is it a structural issue involved with how bonds are managed and custodied, et cetera? What do you suspect is ultimately the blocker for anybody wanting to issue these bonds, regulatory, et cetera, that would stop people from making this a market? Because, of course, the bond market would love to jump on something that is efficient and gives them the best possible prices with lowest possible spread and easiest way to manage. Yet this isn't the case.
Listen, I'd love my car to be faster and cheaper as well. I mean, that goes without saying. I think absolutely people would jump on board that. I think there's a few problems. So there's a sort of general distrust right now sort of crypto and DeFi and all these things, because we've seen all these shenanigans going on at places like FTX. That certainly doesn't help. But I think even some of the people who've been promoting these DeFi bonds have been engaged in sleights of hand, in a certain sense that they make it look like there's more volume than there really is, or they do something like they actually book all the transactions in their traditional systems, in old mainframe systems, and then they copy out a copy of that transaction onto Ethereum and say, look at us, it's a DeFi bond. Well, no, it's not. It's still in the old systems, and you're just making a copy. All you've shown that you can do is you can copy a few transactions from your traditional mainframe system into Ethereum, and that's not terribly impressive. So there's been things like that going on that don't impress people. But I think maybe more fundamentally, the people who are going to have to invest in these bonds and buy these bonds are not technologists. They're not people who are enamored with Bitcoin and blockchain and things like that. These are bond portfolio managers and bond traders. And if you can't articulate an argument to them saying, listen, buy this bond, you're going to get a higher yield, or it's lower risk, or it's going to reduce your credit risk, or reduce your operational risk, or anything like that. If you can't make the argument to those market participants in their terms, rather than coming with technological arguments by saying, oh, it's all distributed and therefore it's better, that is not going to convince a bond portfolio manager. They want to see, I want higher yields, I want lower credit risk, I want lower operational risk potentially, and I don't want these clauses in the bond prospectuses saying that there might be a technical issue and I might lose all of my investment. That puts then an onus on the bond portfolio manager and the bond trader to actually now do a technical due diligence of the bond's platform and infrastructure. They would have to do that. And I don't think any of them are, or very, very few of them are well positioned to do that. And I think even fewer of them are inclined to do it. If you see that kind of bright red warning in the DeFi bond prospectus saying that you might lose all of your investment because of a technical problem, well, you can't invest in it. You can't take that risk with your client's money. You have to stay away from it. So I think those are the basic impediments we've seen in the DeFi bond market so far.
Certainly very concerning. Octavio, thank you so much for joining us this morning. That was Opimas CEO and founder Octavio Marenzi. Let's head over to D.C. House lawmakers are holding a hearing titled Coincidence or Coordinated? The administration's attack on the digital asset ecosystem. Pretty charged title there. Emily, you've been watching this. Tell us what's going on.
Yeah, as you could tell from the title of this hearing, it seems like it's going to be pretty spicy. I looked at some of the witness testimonies. Everybody pretty much agrees that the U.S. is not doing the best job in regulating crypto. And most of the witnesses are saying that we need clearer rules of the road, that we should be doing more. But it's really interesting. I mean, the whole Silvergate thing is very relevant here. I just want to kind of single out Mike Belshie for a moment. All the comments are very interesting and they're worth reading. They're very detailed. For example, Paul Grulo from Coinbase really gets into it and comes up with some very specific recommendations for the US for regulating crypto. But Mike Belshi raises a really important point about Silvergate. And basically what he says is that the problem was that because of the current regulatory environment was sort of alienating to traditional banks and not really encouraging them to get into crypto, you ended up with basically a single point of failure. You ended up with kind of just one relatively small player overly focusing on this asset class and kind of leading to a so-called run on the bank. Whereas if regulation had been more friendly to more traditional finance actors, maybe the risk would have been more distributed and we wouldn't be seeing what we'd be seeing today. And I think that's a really important argument, which is saying that, by the regulatory stance that the U.S. has now, you're actually creating greater risk rather than mitigating risk.
The Brad Shermans of the world that say, well, I mean, good. They let them all fail, let them all go to hell. The U.S. doesn't have any business anyway trying to be friendly to crypto. It's not any good for us. It needs to just go away because, first of all, it was designed to leave the current financial system. So why are you regulating it when it doesn't want to be part of the financial system? So what's the purpose of crypto if you're just making another chapter to what traditional finance? I mean, isn't that sort of like, don't the extremists on both ends have a point that this isn't really something that the U.S. should be involved in? Is anyone making that argument today?
Yeah, I'm really glad you raised that. I think that's a really important question. So if you look at, for example, Lee Rayner's, his testimony, like he's definitely thinks crypto kind of doesn't even have a reason to exist. So he's a little bit closer to that, but he's also arguing for more regulation. And here's the thing. So I actually think you're raising a really important point because a lot of people in the crypto industry, they say things like, oh, Gary Gensler doesn't realize like crypto is going to leave the US if he's not careful. I don't think it's that he doesn't realize. I think there's some regulators in Washington who are kind of like, don't let the door hit you on the way out. Like they're fine with crypto leaving the US. I think the argument to be made here is not this like crypto enthusiast argument, like this is the next wave of innovation. This is so, I don't think some regulators care about that. I think the argument to be made is that whether we like it or not, crypto is here, right? So, and if the US decides not to regulate it, it's not going to make crypto go away. And it actually increases the risk for US investors. And that's what we saw with FTX, right? FTX was a non-US exchange. And look at the damage that has reverberated through the US for investors, for venture capitalists, even for retail, right? So this is just another example.
But I was going to say, but that way, it's still like Signature Bank pretty much focused on the crypto market, right? I mean, like they didn't really. I'm sorry to interrupt. As the day after International Women's Day, but
but they were impacted by the crypto contagion offshore. I mean, this all started with Terra Luna, which made.
But it didn't affect the rest of the financial system. I still went to the bank.
FTX.
I still had dollars in the bank. The FDIC didn't have to liquidate my bank. I think the
argument to be made here, like in response to what you're saying, Lawrence, is that the argument is that if some of these places or some of these projects had been regulated in the US, maybe the risk would have been lower because so say we decide that like we don't like crypto, we don't want to regulate it, let it all leave the US, fine, just go. Then it doesn't actually stop the risk. You could argue that it actually increases the risk. And I think a perfect example, I know we're getting to this later on the show, is Tether, right? So, you look at BUSD and Paxos. They decided to kind of play by the rules. They were, registered with the DFS and, the regulators went after them. And what happened? Who benefited from that? Tether. And if Tether were to implode, the kind of like catastrophe that would have on the crypto industry is much larger. Do you see what I'm saying? So the argument here is that like it would be better if we had more regulated players inside the US.
For someone like Brad Sherman, maybe that's something that they want.
Emily, you also.
Or Lawrence. Emily also wrote a new opinion piece called Keep Crypto in America. You say if the SEC is serious about U.S. investor protection, yes, it should want crypto to stay in the United States. Tell us about it.
Yeah, so that's exactly the argument. Same argument I'm making, same argument that I think Belshi is making today from BitGo in the hearing, which is that whether the US likes it or not, crypto is not going to go away, right? There's always going to be Americans are always going to find ways to invest in it. Either they will go to offshore exchanges, venture capitalists will find ways to invest in it. There'll just always be ways for Americans to get involved. We look at, for example, Terra Luna, Christine, you just mentioned, and there have been articles about how some ordinary investors in the US were destroyed by that. Terra Luna was not in the US. So my argument is basically let's not argue on the merits of okay, crypto's so revolutionary, it's so great, because I don't think regulators care about that. Let's just say if you are serious about protecting American investors, try to keep it within the regulatory framework of the US so that, less Americans are getting hurt by these offshore entities, which are harder for the SEC to regulate and can still cause damage in the US. Because either what will happen is if the US does not get its regulatory act in shape, what you will have is either crypto will go offshore or it will operate in these kind of gray areas in the US, which is more dangerous to US investors.
Yeah, really fascinating. Thank you, Emily. Be sure to catch that hearing to learn more, and we'll be taking it live on CoinDesk at 2 p.m. Eastern today, so don't miss that. Coming up, a look at Tether's rising dominance in the stablecoin market, and CoinDesk's Nick Day weighs in on Silvergate's impact on rival Signature Bank. Next. The dominance of Tether's USDT is rising among stablecoins amid an ongoing shakeup of the $136 billion stablecoin market. This comes as rival Binance USD has been in rapid decline since its issuer Paxos announced it would halt minting new BUSD tokens due to pressure from a New York regulator. Joining us now to discuss is Bennett Tomlin. He's a Crypto Critics Corner co-host. Bennett, so you've been a critic of Tether for a while. USDT is now rising as investors are dumping BUSD amid all this fear, uncertainty, and doubt in the market. What do you make of this?
I make of it that dollars that were parked in BUSD can no longer practically be parked in BUSD after the New York Department of Financial Services notice and the alleged Wells notice that Paxos received related to it. And those dollars had to go anywhere. And it seems at least some of them went into Tether. But even the chart you have on screen right now illustrates that it's gone up a little bit, but we're still below peak for Tether. I don't really, we've seen their dominance increase, but the overall market cap of Tether is relatively flat here.
Nonetheless, by the way, Bennett, I if I could, I would just have like a little like oval with you in it, reacting to the show as it's going on. I was watching you on the screen react to everyone speaking, and it's almost like, you know, when they have the sign language interpreter on the corner. I would love to have that with you, because you were very expressive and it was very, very fun to watch. And I'm sure you have a lot to say about some of the things you heard today. Nonetheless. We've talked about this before, but we saw the demise of, or at least the decline, if you will, of not just, it's not BUSD so much as it's the peg version of BUSD, which is a slightly different animal than what Paxos was initially providing. So a couple of things. First of all, do you have any suspicion that that pegged BUSD was not backed? And if so, do you have any evidence that would support that? Second of all, do you think that the influx of assets into USDT is because USDT is relatively opaque? In other words, it's a feature, not a bug.
So there's been reporting led by analysis from Chain Argos, first run by Protos and then by Bloomberg, talking about how the wallet that was supposed to have the BUSD backing the Binance peg BUSD often did not have an adequate amount of BUSD in it. It is possible, and Binance maintains they still had adequate BUSD, just not in the appropriate wallet. Bloomberg, again, with the help of Chain Argos, then did another report showing a bunch of other Binance B tokens did not have their reserves appropriately segregated out. And so I think it's very plausible that those Binance Peg BUSD often did not have adequate backing. And then as to the question as to whether or not Tether's opaqueness is a benefit rather than a demerit, I think it's plausible, and it's been one of the arguments we've seen for Tether over the last several years, is that the fact that they're offshore, the fact that they are somewhat more challenging for regulators and law enforcement to engage with, and the fact that they do try to keep some kind of veil of secrecy may help protect them. But the type of protection that offers is basically, we're going to delay the regulators slightly and hope that this is annoying enough they won't want to deal with it. I don't know that long term that's really a sustainable idea for a stablecoin to continue functioning.
Where does USDC fit into all of this? Why are they not reaping more of the benefits of what's happened with BUSD? And do you think that, I'm just curious, where do they fit into this whole story in your view?
My intuition about that is that many of the people using stablecoins looked at Paxos supposedly getting a Wells notice and sees the increasing U.S. regulatory crackdown and thinks if Paxos is going to end up in the crosshairs, then so will Circle. And so moving from BUSD to USDC is only a marginal benefit, whereas moving to USDT and moving offshore may be a more substantial benefit than staying onshore.
Were you surprised at this idea that Paxos would have gotten a Wells notice if they did? Do you think that they, because they were the poster boy, as we've discussed earlier, of, complying with regulators, with transparency, whereas even USDC didn't have that kind of transparency or at least security that one saw with Paxos? Do you think that this was a surprise for the market, and where does it go from here?
So I think it both kind of is and is not a surprise. Gary Gensler has been very clear in a variety of statements that he believes stablecoins can and perhaps are securities. I think the surprising thing was no one expected Paxos to be the first stablecoin to allegedly get a Wells notice from the SEC. People thought if the SEC was going to take that tack, there were going to be better candidates for them to start with than Paxos, because as you mentioned, Paxos was regulated by the New York Department of Financial Services and did seem to have a model closer to what regulators seem to want stablecoins to become. And so it was somewhat surprising for them to be the first one, but I am not surprised the SEC is interested in stablecoins.
Are you surprised by the resiliency of Tether? Now that we're seeing more crypto contagion, there is a flight to Tether, and Tether arguably was very much involved with FTX and Alameda Research. I believe it was reported 1/3 of all Tether would end up going to Alameda, and yet they're dominating the market.
Yes, I have been surprised for quite some time now that Tether is as resilient as it has been. As you mentioned, Alameda Research was one of the two largest issuers of Tether, had gotten over 36 billion of them by November 2021 when the Tether papers were published. There was clearly a lot of this interconnection here, and I think that Tether's resiliency has been surprising over the years. They lost banking in March of 2017 with Wells Fargo and continued to survive. They had hundreds of millions of dollars seized in an internationally coordinated money laundering sting and have continued to survive. Like, there are multiple points in the history of Tether where you would not expect them to necessarily continue operating after those events, and they have. And they're still operating. No matter what else I say about Tether, they do still exist.
Yeah, well, the Wall Street Journal was reporting that Tether used bank accounts and the names of executives of various companies, slightly tweaking those companies' names to maintain its access to the global financial system in 2018. So what's going on behind there?
Well, I mean, yeah. So we did get that reporting from the Wall Street Journal, but the interesting thing about it is we already knew a lot of what they were reporting from the New York Attorney General's settlement with Tether and from the CFTC settlement with Tether, both of which talked about some of the arrangements they used to maintain access to the banking system. Excuse me. The New York Attorney General's settlement talked about Bitfinex and Tether using friends of Bitfinex, which were literal human friends whose accounts they used, which in the case of the Wall Street Journal reporting would match up with like Christopher Harborn or Chris Lee running High Lab Holdings. And so we see this basically as confirmation of those earlier settlements. And yeah, and then in the CFTC settlement, we saw the discussion of Tether having like dozens and dozens of arrangements with various other individuals, payment processors, and whatever in order to maintain their access to banking, many of those largely undocumented. And that matches up with their use of Crypto Capital Corp, which ended up with their funds being seized. And it matches up with the Hamas money laundering scheme that Wall Street Journal pointed to in their reporting on Tether.
So is there anything nice you can say about Tether's, the way in which they are, they've claimed that they're not really involved in commercial paper anymore. Do you buy that? I mean, would you say that they've actually cleaned up their act somewhat and gotten out of that business? Or do you think that, do you have any other concerns about what's right now on their balance sheet?
I do have concerns about what's on Tether's balance sheet. As to like the question of commercial paper, I think one of the most interesting things with that was when the Financial Times, I think it was, heard that Tether was allegedly the 7th largest holder of commercial paper in the world. And they went out and tried to confirm that fact and really struggled to find anyone in the commercial paper marketplace who recognized this new entrant coming in and buying up these billions of dollars of commercial paper and becoming the 7th largest holder. Tether's commercial paper in that sense has always been kind of an enigma. No one can figure out where it came from or where it went. And so, yeah, I think it's plausible they don't have very much commercial paper on their books anymore, but the challenge is it's hard to prove they had that commercial paper when they said they did, because when people went out and tried to report it, they could not find that commercial paper anywhere in the financial system. And so, yes, I still have concerns about what's in Tether's reserves.
They didn't look in China, did they? Just saying.
I mean, people have tried, but like then you get into the issue of Tether was making claims about the credit rating of their various issuers and pointing to various credit rating agencies to support those. And so then you need to, if you're suggesting it's international commercial paper, figure out how they're supporting those issuer ratings, assuming they're being honest about them.
Just quick clarification, where exactly is Tether now? I mean, where are they technically headquartered or registered? I mean, it's always kind of the eternal question.
They're registered in the British Virgin Islands and Hong Kong, right? Their executives seem to spend a lot more time in Switzerland than either of those two places, but there isn't like a single headquarters for Tether as far as we've been able to tell. No one's been able to find it. And whenever you ask any of the executives, they'll tell you that like Binance, they see themselves as a globally distributed company with no single headquarters.
So Inspector Gadget and the plastic surgeon, were they hanging out with
in the Bahamas? Yeah.
They were spending time with Sam, right?
With SBF.
Yes. At the very least, they shared the banker in Chalopin and Deltec. I don't actually know how much physical time like Juan Carlo or JL has spent in the Bahamas compared to like Switzerland or something like that.
All right. But he does make a good pasta. All right. Paolo Ardonino, the chief technology officer of Tether, tweeted last week that the Wall Street Journal report contained a ton of misinformation and inaccuracies without giving specifics. CoinDesk also reached out to Tether for comment on the Wall Street Journal report, but did not immediately hear back. So, Bennett, thank you so much for joining us this morning. That was Bennett Tomlin, Crypto Critics Corner co-host.
Thanks.
Well, so what does Silvergate Bank voluntarily liquidating mean for its rival, Signature Bank? That's a question we've been asking today. And joining us now to discuss a little bit further is CoinDesk Global Policy and Rating Editor Nick Day, who's also the editor. That's absolutely must subscribe to State of Crypto newsletter. Hey, Nick, happy Thursday.
Good morning.
So a recent analyst note from JP Morgan is actually a little bit mystic here about Signature as far as the share price goes. Of course, Signature Bank is another bank that is involved heavily in crypto. How important is this issue with Silvergate as it relates to Signature Bank, and how important is Signature Bank in the overall crypto market, especially now that their big rival has called it quits, to say the least?
And well, obviously, just to start with, Signature's role is probably about to become a little bit more prominent. Number of clients that used to use Silvergate are going to be looking for alternatives, and Signature is in a pretty prime position to take advantage of that. And even though last night when Silvergate announced it was going to be liquidating, Signature's after-hours trading's share price dropped for a little bit. It seems to be up a tiny bit now. I don't think the market's actually opened, or it might have just opened, so too early to tell what the actual reaction is, but Signature's in a good position. On the other hand, bank regulators have been warning for quite a while now that crypto is a dangerous area, with a potential, huge amount of risk for their services and for the financial institutions that are involved. So I imagine Signature is also going to become, part of it's going to go under a, tighter microscope. Regulators are going to want to know, how do we make sure that nothing happens to you the way that things happen to Silvergate? So, for Signature, they're probably going to take a look at what it's put its money in, what kind of deposits it's got, whether or not it's experienced any bank runs similar to what Silvergate had over the last couple months. So the regulatory scrutiny, I imagine, is going to ramp up. The congressional scrutiny is certainly going to ramp up. And, how companies react is probably going to be, part of that, that view. People are going to want to know whether or not the clients are staying, and if so, how are they staying?
Yeah, and I suppose, are we going to see a flight of crypto companies towards Signature Bank? And could that potentially have the same problem that Silvergate had, where they were just so focused on crypto companies?
It's possible. I think Signature, it comes with a bit of an advantage in that it already has, it's better established in not just crypto. It has a fairly robust, I think, real estate business or aspect to its business. So it's not reliant on a single industry the way Silvergate appears to have been. So that's one benefit or one advantage Signature will have. Should there be another bank run, or should there be another, FTX-like collapse spurring companies to withdraw, it won't necessarily spell the end for Signature. On the other hand, real estate is also in a pretty weird position. So, as far as risk goes, there's quite a lot of it, but it's not going to be as concentrated, and that's one benefit for Signature.
All right. We got to end there, unfortunately, but Nick, thanks for the update. And that's it for First Mover as well. Thank you, Emily and Lawrence, for joining me. I'm your host, Christine Lee. You're watching CoinDesk TV. Also, next up, stay tuned for the daily forecast to see what's happening in the Asia crypto markets right after this break.
One of crypto's biggest banks just went bust. Silvergate Capital has said it's winding down operations, unable to continue after struggling for months with losses. If a financial institution of its size can't go on, it begs the question, is crypto unbankable? This is a big deal. Silvergate has been going since 1988 and has served the crypto industry for the last decade, but we can't say we didn't see this coming. Last week, Silvergate said it was less than well capitalized after a run on deposits. That was prompted by the company shutting its Silvergate exchange network payment system. The exchange had been used by large traders and crypto firms, but the likes of Coinbase, Circle, and Galaxy Digital quickly took their money out of the bank. Shares, of course, have tanked and will fall further after the latest announcement.
I thought it was super hot, a stable business, but it just all happened because of the FTX bankruptcy. So all of a sudden, the business just, we don't even know it's existential anymore, Silvergate Bank. So yeah, I was quite shocked.
Silvergate had a lot of exposure to FTX. Last year saw customer deposits crash almost 70% to less than $4 billion. To cover that, at the start of 2023, Silvergate said it was selling almost $5 billion worth of assets for cash, but it had to take a 20% loss on those. In January, it also laid off 40% of its staff. Contagion remains a big concern, and Silvergate's collapse shows that the ramifications of FTX's own demise are still being felt.
I think I have to change my projection because I thought at that time the FTX contagion was pretty much over, but now I think it's not over yet. It can grow.
But the impact of Silvergate's liquidation could yet expand too. In its latest announcement, it actually cited regulation as the key factor. The company said in a statement, quote, "In light of recent industry and regulatory developments, Silvergate believes that an orderly wind down of bank operations and a voluntary liquidation of the bank is the best path forward." 2 months ago, Silvergate had gone to the US Federal Home Loan Bank to borrow $4.3 billion that appeared to get the attention of US lawmakers. Senators, including Elizabeth Warren, wrote a letter to Silvergate boss Alan Lane at the end of January. After previously asking Lane about transfers the bank did for FTX, they accused Silvergate of further introducing, quote, crypto market risk into the traditional banking system. At a time when lawmakers are poised to bring in new rules for cryptos, some say this event could push them to be even more strict.
I'm sure there will be new regulations coming in and make them harder to open up a bank account and trade their assets within the US onshore.
It's also likely to put off other traditional financial institutions that aren't already involved in crypto. In an article on its website, Saxo Bank said Silvergate could serve as a worst-case scenario. Quote, this may cause banks to be more cautious and less willing to offer services if it relates to crypto at all, effectively harming the industry's ability to receive a bank account and limiting innovation in the space. Ram Alawalia, CEO of digital asset investing firm Lameda Wealth, told Reuters that contagion from Silvergate is unlikely, but he added the loss of the SEN could be significant, saying, quote, it's more of a strategic loss of critical infrastructure for crypto. There have been worries about what the closure of SEN could mean for USDC. Circle tried to calm those worries last week by putting out a statement saying they had moved their assets from Silvergate.
Definitely something that's worrying in the space. It's not super surprising. I mean, it's been brewing up for a while now. Obviously the thing the connection with Silvergate and stablecoins, especially USDC. So and USDC is so inherent in the whole ecosystem, especially with like almost everything is traded against USDC.
Signature Bank is now the de facto bank for crypto. While its deposits seemingly dwarf those of Silvergate, its exchange network is not nearly as widely used. Signature also appears to be trying to move away from crypto in the wake of FTX. CEO Joe DiPaolo told investors in December, quote, we are not just a crypto bank and we want that to come across loud and clear. So then what's next? Is crypto unbankable?
Banks can coexist with the crypto, and the only thing they need is more regulation, more trustworthiness, and creditworthiness.
It all comes back to trust, doesn't it? All right, that's it from us for this episode. Do like and subscribe to this video if you want to see more content like it, and please let us know your thoughts about what's going on at Silvergate in the comments below or wherever you're watching this video.